Hey everyone, thank you for attending the Place Your Trades Network Spaces to discuss North American oil and gas. This Spaces is brought to you by Tradevate, which has a custom web app dedicated to trading CME Group's new daily option contracts, including indices, energy, metals, and now Bitcoin. You can now trade these on the DOM on Tradevate's main platform as well as the app. It's a great way to get exposure to the futures market with limited risks. You can use the link in my Twitter stream to get the Tradevate app for free. I also write a weekly blog and daily pre-market overview on markets that you can subscribe to at placeyourtrades.com. It doesn't cost anything. And then starting something new, I'll be doing a summary of this episode with my key takeaways that'll be available as a download PDF on the Place Your Trades website tomorrow. So keep an eye out for that, and I'll also tweet a link when this is ready. And now on to our guests. First, we have Eric Nuttall, which probably doesn't need much of an introduction in this sector, but he is a partner and senior portfolio manager at 9 Point Capital. The 9 Point Energy Fund seeks to achieve long-term capital growth. The fund invests primarily in equity and equity-related securities of companies that are involved directly or indirectly in the exploration, development, production, and distribution of oil, gas, coal, or uranium, and other related activities in the energy and resource sector. His main fund is the third largest energy fund in the world, and it was #1 in the world in 2019 and 2021, according to Morningstar. Next, we have ArjunNMurti, which he probably doesn't need much of an introduction either, but Arjun spent 30 years on Wall Street as an equity research analyst, the bulk of which was at Goldman Sachs. For the past 8 years, he served as director and advisor within the energy space, including at a large E&P company, a private equity firm, and an energy policy think tank. He has recently joined Veritian, I hope I said that right, an energy-focused strategy and investing firm as a partner. He also publishes a Substack under the Super Spiked name, which is fantastic. I encourage you all to go look that up. He's got a link in his Twitter bio. All right, so we'll get right to it. First, we'll start with Eric. I kind of want to start with a macro view first before we kind of dig into Canada a little bit here. So you posted something, Rystad, as well as other energy sources, have cited that due to OPEC plus cuts, the oil market's going to move into significant deficit of almost 2.4 million barrels per day starting this month. So why do you think that markets are ignoring this? And I'll put the graph you posted, I'll retweet it on Twitter.
You bet.
Why do you think? Go ahead.
I just think we've all been disappointed one too many times, and we're in this market where people need to see it to believe it. We were told by many, you can question the magnitude, but I would say we were probably all expecting Russian volumes to roll a little bit harder than they had, and so disappointment on that level. The pace of China reopening, China demand normalization, probably a little disappointing to most. And so I just think it's this weird market where you do have, the paper market up against the physical market. We still think that to shake people from this recession narrative, it's going to be draws that will be the curative to that. Many of us would have the same kind of stock draws expected in the next couple of months. Like we think we're at the turn now. Like I'm not seeing it in Kepler data globally. Probably looking for a pretty big draw tomorrow in the U.S. But in the coming next couple of weeks, we're expecting the combination demand normalization, demand continuing to be decent, but most importantly, high compliance to the OPEC plus cuts plus the Saudi voluntary/discretionary cut. So that's kind of what we see. Like we've been wrong so far this year. Like we've been bullish, but we think the turn is coming in the next couple of weeks, which is kind of unique. Like as an investor, it's not often that you can kind of see a scenario where sentiment remains deplorable. You can see that from funds flow, exodus, sector rotation, all of those different things. But then fundamentally, you can point to a very visible catalyst that should drive a pretty significant re-rating, we think, in not just oil, but more importantly, energy stocks.
Well, I mean, we've had kind of these recession concerns for months now, right? Everybody's been waiting for this recession. So, and that obviously is contributing to lackluster participation in this market. So how do you think, how long is this going to last?
Yeah, so yeah, we've been dealing with recessionary fears for a year, generally speaking. And it's interesting, like we follow inventories, kind of one of our most major um, kind of balances to look at to evaluate what price should do. And historically, the R squares have been pretty strong up until June of last year, and that's when the relationship completely broke apart. So you could argue, well, that was the SPR, and that was distorting. Like we try to adjust inventory balances ex SPR to evaluate the under or oversupply of the market. But I think it was key. That's a key time frame. June of last year, recessionary fears started to peak. Stocks peaked as well, falling by 30-40% ish from those highs. So yeah, you've got one market, the paper market, saying we're entering into recession and using oil as a financial instrument to express that negative view. And then you've got guys counting barrels saying, well, geez, we could have one of the sharpest draws in inventory globally in history. So we're going to know. I'll know if I'm right or wrong in the next 2 months, I would say. But again, it comes down to magnitude. It's going to be the magnitude of the draws that overwhelm the ongoing recessionary narrative, and it's just getting annoying. Like you're not seeing it anywhere. Like we subscribe to Rystad, we can see demand in real time. The pace of growth is moderating slightly, but we're still in growth mode. And then you see 2 million barrels per day plus of cuts coming in the next couple of weeks. So I don't understand the pervasive level of extreme bearishness.
We're all scratching our heads, I think. Right. All right, we'll get into Canada for a little bit. I'm going to Arjun really quickly and kind of ask you sort of the same questions, but not exactly. But so when we look at speculative positioning in futures markets and even in the equity markets, right, in the energy sector, there seems to be an indifference in both energy and actually metals markets as well, despite warnings we're going to be undersupplied in many of these critical metals for energy transition, and we're going to be undersupplied in oil. So what are your thoughts on this and why?
Tracy, first of all, it's a pleasure to be here, and it's a pleasure to be here with Eric especially. I don't think Eric and I know each other than Twitter, but I've enjoyed following him, and I certainly appreciate his, I think, longer-term views on especially the Canadian oil sector. So thank you for having me. So I'm going to take just a slightly different tact on all this, which is I don't get why we obsess so much about OPEC cuts or, frankly, about inventories. And it's going to be a little bit and I'll give you some examples. Inventories drive, as I know you know, Trace, and I'm sure Eric does as well, the front end of the curve. You either have backwardation when inventories are low and drawing, or contango when they're high and building. But that's all the information you get. Now, for long periods of time, we saw this in the 90s, we've seen this over the last 5 of the years, there isn't always action at the back end of the curve. But for everyone calling for a super cycle in oil, which I don't, I call it a super vol environment. I call it a profitability supercycle for the companies. And that is something I remain very excited about. The profitability for the sector, I think, is on track to be pretty good for the foreseeable future. But as far as the oil macro goes, super vol, not super cycle. And back end oil is still not doing much. Now let's look at 20 years ago, the super spike era. From 2004 to 7, for large portions of that period, inventories built. And the front of the curve went into contango. But what drove oil from 20 to 65 and ultimately to 100 was back-end oil rising as the market saw that Chinese demand was insensitive, that emerging market oil demand was insensitive. So big surprises on the demand side positively, which we're not having right now. And at the same time, the brownfield exploitation projects that drove non-OPEC after the 70s, those were starting to peter out. So you were starting to get cost inflation. You were starting to get the recognition F&D was not going to be $6 a barrel. It was going to be 8, then 10, then 12. And then we needed to figure out, what are we doing next? Are we doing deep water? Are we doing oil sands? Are we doing Arctic? Are we doing Russia? And you had a massive rally in the back end, despite at times inventories building, right? And I remember fighting the perma bears. Me and Jeff Curry, my partner at Goldman, he's still there. We'd often fight, and he had the correct line. long-term shortage creates short-term surplus. And you've kind of got the inverse of that right now. We're not in an environment of booming demand. Demand is fine. It's nothing like what the IEA net zero report says oil demand is going to grow. But the fact that it's going to grow and not fall off a cliff is not the same thing as saying it is booming like it did 20 years ago. So you're not getting the sort of upward demand surprise with upward supply. And at the same time, when you look at non-OPEC supply, we've obviously had growth in Brazil, Guyana, a little bit of oil sands. But look at the Permian. For all the maturing we're starting to see with individual companies, you are still getting production growth when the rig count goes up. And it takes a lower rig count for supply to go off. So to get the super cycle, what I'd argue you need is a much more fundamentally strong economic background. By the way, in Europe, US, China, your most important oil consumers, in none of those countries would you say you have booming economic conditions. They may not be recession. It may not be terrible, but they're not super cyclish kind of conditions. What we are waiting for, though, is that non-OPEC maturing, which is clearly happening. You're starting to see the cost curve steepen. My former colleagues at Goldman still published that I used to contribute to, the non-OPEC top projects report. You're seeing a clear maturing and steepening of the cost curve, but it's not manifested yet. So if you look at CL60 or 5-year forward oil, it's done nothing. It went down a little bit during COVID. It rallied a little bit back last June, but it's not signaling yet that we're in a super cycle. And let me just close here, Tracy. I do wonder if this environment, I'm going to call it super vol and grind it out, this may be the better one if you actually care about equities. Because look at the last super cycle. I call it the quadrilateral of death. From 2002 to 2006, oil up, return on capital up. From 2006 to 2008, oil up, return on capital down a little bit. 2008 to 2014, oil stayed at 100 and returns on capital collapsed. There is no chance that that is a good environment for any energy company. Look at it this time. This time we've had a structural uplift in profitability. Now, I'm as skeptical as the next person as to how sustainable that is. And I can see the Crude Chronicles here. I would reference his great Substack and the 100-year history, which I agree with. But for a period of time where people fear IEA net zero, where they fear, okay, China is kind of having some sort of, challenges and inflection here. When they say don't invest in oil and gas because you guys stink, you wasted all my money last decade, don't you dare invest again. When OPEC spare capacity is limited and CapEx is still low, all of that argues for structurally better profitability for a period of time until they start wasting money again. And when is that going to happen? Now, this can vary greatly by individual company. So the more assets and longevity you have, and this is where, again, I agree with Eric, or I think I do, where companies like in the oil sands who have long-lived resources and still debottlenecking opportunities, that is a huge structural return on capital advantage, and that is what I would focus on. There are traders out there, so if you want to make the call that in the second half, we're going to have inventory draws and prices are rally, have at it. But all you're arguing in that is contango to backwardation. You're not arguing the structural cycle, and that tends to be more the focus. So sorry for the very long answer there, but I just wanted to highlight maybe some differences in the interest of not making this too boring.
Oh, no, absolutely. And that was my next question, was going to be on your article in Super Spike. So if everyone wants to go read that, where it's called Oil Super Cycles are about upward pressure on long-dated oil, not near-term inventory movements. And I was going to ask you about that, but you kind of covered that already. So,
yes.
So do you think, and this is, again, we're still kind of on this macro trajectory right now, and then we'll kind of get more into North America and oil and gas. But looking over to Europe, do you think the ongoing retreat of European financial from traditional energy really matter to this cycle right now at this point?
So I think it's the biggest risk long-term to both the sector and, frankly, world economies is what I call the Glasgow Financial Alliance for Net Zero. I think it was encouraging to see that the Net Zero Insurers Alliance, and maybe slightly off on the name or the acronym, they disbanded after some pressure from attorney generals about collusion and so forth. But I really can't think of any bigger risk to humanity than telling the major banks, capital markets, and insurance providers, you are not allowed to invest You need to have emissions finance as your trajectory. You can be all for decarbonization. You can think that's a good objective. We should care about these things, and that's totally fine. It's another thing to basically pressure U.S. and European banks and insurance companies to essentially stop financing U.S., European, and Canadian oil and gas companies. I do not understand how that philosophy makes any sense when we clearly have a lot of supply potential out of places like Russia, the Middle East, and elsewhere. And again, some people may like those countries who are on this call. Some people may not like those countries. But if you're an American, if you're a European or a Canadian, I cannot understand how anyone can allow there to be these alliances that de facto cut off or attempt to cut off financing and insurance to our companies. It just there's no logic to that. And I'd say I think we're starting to see pushback. The disbanding of the insurance alliance is a good sign. And I think the banks are going to have to come to terms with what does an emissions finance target really mean? And who does that get applied to? And why does that effectively only get applied to American, European, and to a lesser degree, Canadian companies? I say a lesser degree only because at least Canada has its own banks. And as best as I can tell, and Eric will know better, they seem still supportive of the sector. So hopefully this risk is fading. But I really, so much attention gets focused on ESG and investors. I think that's more of a sideshow. I think the bigger risk is this pressure on banks and insurance companies to stop financing American and European and to a lesser degree Canadian companies.
Yeah, and we just saw Vanguard leave the Net Zero Banking Alliance. So maybe
that CEO deserves a lot of credit. I mean,
right?
I will agree that it's not easy to leave these alliances, and I will agree that they may not be energy experts if you're the CEO of a bank and these insurance companies. So somebody's, yeah, let's do emissions finance. That sounds good. And yeah, I want to be Paris aligned. That sounds good. And I get all that psychology if you're not an expert. But when you really go through it, there's probably no more awful of a target than emissions finance when, again, it's only going to be applied to a portion of the universe. And again, I know everyone on this call probably knows U.S. shale supply has been 70% of global oil supply. Now, maybe it's maturing. Maybe that is the reason we will have a more bullish cycle long term if we're not trying to find the next resources. And Canada, thank goodness for Canada and the contribution it's made to global supply. And I think we should be doing everything we can to figure out ways to extend it. And of course, U.S. and Canadian supply is not just relegated to shale and the oil sands. There are other areas, there are other states. Alaska is a state that, believe it or not, is part of the United States. Gulf of Mexico counts as part of the United States. All these areas are deserving of our investment and support over the long term.
Excellent. Now, going back to Eric, we'll get into Canada for a little bit. But first, I want to say you had like an infamous tweet, well, in my opinion, where you said, when sentiment improves, this is the hunting ground for multi-baggers. So we already know you're a well-known bull. So explain to us why you're so bullish and what are you particularly seeing with, regards to Canada or perhaps anything in the U.S. as well?
Yeah, so when we look at the free cash flow that these companies are generating, both at current pricing, like if no one should ever try to call a bottom, but let's assume we're kind of peak bearish just now. We've been calling for a recession for well over a year. We're still trading barrels at around $70. We've got the sector trading at about a 12% free cash flow yield. Some Canadian slightly more than that. When we look to even as $80 oil, we've got companies up here with, as Arjun very eloquently said, like multi-decades worth of inventory, 30 to 40 plus years, as opposed to 10 or less for the average shale guy. Our well profiles typically don't get worse. They're static as opposed to, eroding, going tier 1 to tier 2 to tier 3. So from my view, like I combined names at 20 to 25% free cash flow yields at $80 oil with their strongest balance sheets in their history, the most profitability in their history, the most free cash flow in their history, and most importantly, a commitment, like a steadfast promise to return 75 to 100% of that free cash flow back to us, primarily in the form of buybacks. And so to me, that is just so critical because that is, I believe, going to be the catalyst to drive the re-rating. Because whenever I would market with prospective clients, they say, Eric, the macro sounds bullish and all, but what if people don't care? What if, the ESG and divestments and all of those conversations stymie the ability for funds flow to ever return? And so it was critical to kind of create a philosophy which resulted in a potential catalyst, I think, coming in the next quarters to over the next several years. And that is companies basically saying, if you do not see the value in our asset, in our stock, we do, and we'll use every nickel of free cash flow to buy it from you. And so it's exciting to me as one of the biggest proponents of that initiative that, with very, very few exceptions, that is a philosophy shared by all companies in Canada. And so, I'm bullish on oil. I've been wrong year to date. We still think we're going to rally pretty hard by the end of this year, and at 80, 90, 100, higher, I think, in the next several years out, with these companies able to essentially privatize with 3 years, 4 years of free cash flow, we're getting decades worth of inventory, free cash flow, dividends, literally for free. So that's the short version in terms of why I'm excited about Canada. Just, I think, global energy investors, we are the only game in town now. As people get incrementally more and more bullish on oil and realize that demand's going to last stronger and longer than the average person believes, and you can buy again decades worth of inventory for nothing right now.
And then, let's look at some of the things that could maybe hinder Canadian industry with regards to, say, federal policy. It looks like, they're looking to place a cap on oil and gas emissions. So do you think this will impact the valuation of Canadian producers?
I think it already has. Like, if you look at our majors, I can't get specific on stocks, but there's 5 of them. So if you look at them, valuation relative to their U.S. peers, we're trading at a 0.5 to 1.5 turn discount. And it's my belief that when you evaluate, free cash flow profiles, balance sheets, inventory depth, inventory quality management, all of those things, the most explainable reason is we traded to discount due to perceived political risk, given our existing government now. So in terms of things that could screw up the thesis, there is plans on putting an emissions cap. It's still a work in progress. The government's kind of backpedaled to say, well, it's not going to be necessarily a production cap. Prior, it would have been, the biggest risk was takeaway. We're the dumbest business in the world. We send 99% of our product to a singular customer, and that is the U.S. Gulf Coast. And so finally, we're going to have an alternative through the expansion of a pipeline coming into service. It should be by the end of this year. I was at a conference in New York meeting with a lot of the larger oil sands guys. Everybody thinks line fill is going to start Q4. So that's almost 600,000 barrels per day of new takeaway capacity. And most importantly, that's diversifying our customer base, gives us better negotiating power, should mean differentials, not just stay lower. Currently now is about $11.25, give or take, US, but it should avoid those times when we get spikes to $30 or $40, which I think was another reason why people wanted to shy away from Canada. So you've got positive rate of change on inventory depth. You've got positive rate of change, I think, coming in oil price. And now you've got positive rate of change in terms of takeaway capacity.
And then in that same vein, how is, there's been a build out of LNG facilities in Canada, which is great because really haven't been able to export much. So kind of what is that looking like right now? And is it enough capacity to make a big difference?
Yeah, so phase 1 of LNG Canada is supposed to come online 2025, 2026. So in my mind, it's not quite yet an investable catalyst. I saw Shell recently, and I think from public commentary, they said that they would typically like to have the first train, train 1 and 2 running before you sanction 3 and 4. There's still some uncertainties about how it's powered, because it has to be run off of hydro, which is there enough hydro and emission, the lines and such. So it's probably not till like 2029, 2030 for phase 2. So for us, we're more a direct beneficiary of the build out of US capacity. We've got 2 companies with offtake agreements with Cheniere. So we're going to indirectly benefit, but it's kind of pathetic, frankly, that it took the U.S. less time to land a man on the moon than it will have taken Canada to build its first LNG facility.
That was actually kind of funny. Um, but true. All right, so we'll go back to Arjun really quickly. We had a question from Twitter for you, from Hardy AIM. Anyway, how much more can U.S. production be increased? When will production peak, and what is the likely decline rate once past peak production? And what's the rough break even for swing producers in the U.S.? It was kind of a lot of questions he had, but
Absolutely.
I'm glad Arjun got that one.
And actually, Eric, I just wanted to make a couple points on Canada, which I'm wholeheartedly in agreement with you. There's only one area I disagree with you on, Eric, in Canada, and that's it. And that is, I don't believe those companies actually require a much higher oil price. Clearly, the sentiment may help the stocks, and if we went from 70 to 100, there's no doubt they would have a tailwind. But I've always been impressed that Canada, frankly, Canadian oil companies, especially oil guys, they've just been maligned. If you did word association, people would say high cost, dirty, last barrel, and none of that is true anymore. If you look at returns on capital over 10, 20 years plus, the Canadian oils are as competitive as any super major. And yes, they struggled during the sort of COVID years and a little bit before that, as everybody did. But that long life free cash generation, it is really impressive. And unlike the US shale industry, which, by the way, the Canadian oils blew away in terms of profitability. It wasn't a close call. They invest in Canada by the nature of it on a full cycle basis. That is why basically they avoid the mistake the shale guys made of just looking at the marginal well IRRs. And I think it's just a huge disconnect that's underappreciated. I think we look at the environmental footprint of Canada and a handful of facilities. It's very different than drilling thousands and thousands of wells and pipes, et cetera, over large swaths of acreage. And then when you look at the plans Canada has to deal with their Scope 1 emissions, for folks that are especially focused on that, you're going to take all the inherent disadvantage away of the Canadian oil sands through that Pathways Alliance project. There's still some execution risk with that project, et cetera. But I actually think Canadian oil, this is one of the keys to having a healthier energy evolution. In the pipeline out west, there's no way Canada should only be selling oil to the U.S., so good for them for however long it did take and for however much it did cost. At least it's getting done, and I think it's going to be a pretty good event for the Canadian oil sector. So it's a very maligned sector. It's undeserved. And honestly, when you see the media and others write about it, and they have some picture of like a 1970s mine, you have to push back on it. It doesn't mean they were perfect 30 years ago. They probably weren't. But again, I think I'd take Canadian oil over oil from just about anywhere else in the world. And I actually don't think that's a close call. In terms of, in terms of the U.S. oil production, again, we're looking for signs that the rig count can go up and you don't have more production, and you don't see that. You don't see that in the Permian. And so there's a lot of people that have done a lot of great work. I used to be on the board of RS Energy Group, which is now part of Enverus. There's my friend Tom Lowry of Flow. And so you can go through individual companies and look at the maturity of this company or that company. And there's no doubt they all overstate their inventory. So when they say 15 years, it probably means 10 of tier 1, tier 2, and you take away the last couple of years, and you're down to a much shorter inventory runway. But I'm not sure if that's true for the larger companies. I think there is more running room there. So can overall U.S. shale supply grow several 100,000 barrels a day a year, and maybe in an upside case grow 500,000 barrels a day? Let's just call it for the next 3 to 5 years. Whether that you can take that all the way out to 2030 or not, I'm not sure. But I see no reason why shale cannot, U.S. shale, especially by the Permian Basin, won't continue to grow. There's no evidence it's not. Now look, when in 2020 during COVID with the rig, production was very negative. So absolutely, if you had very low oil prices, production would fall. But I think you're going to have to see actual evidence that at a flat rig count, that production is starting to roll over. And you just have not seen that yet at the aggregate level. So then when you add in several 100,000 barrels a day out of the Permian and some increment of growth out of Canada and Brazil and Guyana, then the question is, what is rest of world doing? And that's a number that had been declining. So you'd say it's going to offset a lot of these other countries. That wasn't the case in 2022 to 2020. So I think we'll see how that trend continues. But there is the ability for OPEC to creep production, even though their spare capacity is otherwise limited. So if you look at United Arab Emirates, in particular, and maybe to a lesser degree, we can debate Iraq and some of these other countries. When you add up all these pluses or minuses, do you get to 750 to a million, which might be your demand growth? I think you do. And again, that's why I'm not a super cycle guy. If we start getting to where global demand growth starts getting well north of one, let's just call it 1.5 plus, and where the oil price goes up and demand continues to grow, and it's critical points. It's not just any 1 year of demand. You need it to come with a higher price and then to baseline that. That's what we saw in 2005. +3 globally, a big chunk out of China, and oil went up a lot and then stayed up. And so even though the +3 million barrels a day demand growth, and I think it was 2005, was not sustainable, you added another 1 to 1.5 on top of that in the following year. You just never caught up. I mean, you never caught up till shale came on. And so you're looking for a return to that kind of environment, or are you looking for a return to the environment where, again, I'm going to simplify it and say Permian rig count to Permian production has to truly roll over at the aggregate level to believe in super cycle. And again, to make the case for Canadian oil, since Eric's on this call, I do not believe you need a super cycle. I do not believe you need $100 oil for those stocks to generate competitive returns and payout. It may be more boring. I get that. You may have to deal with months on end of investors not caring. But profits are irresistible, and dividend growth is irresistible. Look at a company like what's an example I was looking at? Murphy USA, a retail. Who the heck cares about retail gasoline? I think they bought back like half their shares in the last several years. It's boring, but then ultimately the stocks reflect what are good profits and good fundamentals. And so I'll always say, give me a 15 to 20% return on capital at $70 oil. I'll take that all day and every day over some short-term move to 120 or 150 that feels good for about 5 seconds. And then you're in the worst of all worlds. You have capex inflation and cost inflation and these kind of things. So I do wonder if a non-super cycle, a super vol, grinded out kind of world isn't better, because what happens then? You'll have people continuing to believe the IA net zero. It's a ridiculous scenario. It's completely wrong. It is basically advocacy. It makes the world poor. But people believe it. And a result of believing it, you're getting underinvestment. Now, whether that leads to super cycle or not, we're kind of debating the timing of that. And my view is we're not there yet, or at least we don't have evidence of that. But you also need the demand side as well. So just because IA net zero is wrong and bad and all these kind of things doesn't mean we're in some economic boom. China's had peak industrialization. They've also had peak population growth. There's nothing about those two phrases that make you think China demand is going to be the one that surprises to the upside. So then what is your path for India, for other parts of Southeast Asia, for Africa and so forth, to take up that growth mantle? India is not going to develop like China has. China was an industrial development. That is not the nature of India. So the nature of the oil demand is going to be different, which doesn't mean it's not going to grow. It's just not going to grow like China did, right? And so there's an impatience for a super cycle. There's a rush to call it that. We should all be really excited that the decade of zero profits is probably going to lead to a decade of well above 15% returns on capital, especially if this kind of environment where people are debating net zero. And I think they're wrong, but they're debating it. And they're not cranking up capex. It is a much healthier environment for this sector, even if it's more boring, including for the Canadian oil companies.
Whoops, I forgot to unmute myself.
I got to stop making speeches. I really do apologize.
No,
I'm loving
I love
it. I think we're all loving it.
Right? I'm all on board on that. Well, just because you brought up, and I don't want to really digress into China and India too much, but just because you did bring that up, do you think that, there's been a bunch of forecasts that India demand is going to outpace China demand by 2027? Do you think that's unrealistic?
If they mean outpace on an annual basis, that may be possible. Clearly, the aggregate total numbers are massively different. And I do think, China will grow oil demand. They're going to grow natural gas demand. And probably most surprisingly, they'll grow coal demand, right? And so that, one of the neat things about coal is that it's now 90% a non-OECD fuel. So you've eliminated all your demand hit out of the US, Europe, and mature countries. And you're left with the developing world that needs any form of energy, as we know. They don't just need they'll take any form of energy. Most of them are, or many of them are long domestic coal, and it's a no-brainer to use it. So I do think coal continues to grow, and I do think China oil demand will grow. I mean, I think India will surpass China as kind of the most important economic driver going forward, but it's coming off a much smaller base. It's not going to be the sort of cement, steel, industrial economy. I mean, the nice thing about India is it has more of a service economy. Obviously, for a variety of historical reasons, they speak English in a massive way there, so you get a whole different sense of a support economy to the rest of the world and so forth. So the nature of Indian growth is going to be different, and it'll be, in some respects, less oil intensive. And I think all these countries, whether it's India, whether it's Vietnam, they're going to use coal, but they're also going to care about using electric vehicles. Why is that? If you're China and you import 12 million barrels a day, you'd rather have a coal-fired EV than an OPEC-fired ICE vehicle. So, so when people talk about these newer areas, it's not as simple as saying, hey, I'm a net zero ideologue, and that's all that matters in the world. No. I think if you're India, you're going to try and do a whole bunch of different technologies. So you look at the supply demand of these individual countries, and you look at what do they need to import and what do they have domestically. Most of them have coal domestically, and I think that makes the case for coal. A lot of them do not have oil, and they actually do not have natural gas. Now, one of the things with the LNG forecast people need to be careful about is it's not really competing against coal. Coal is going to crush LNG. It's not a close call. Where LNG works is if you're burning crude oil or if you're burning nothing. Right. So if it's to get your surplus power generation, and so I think people have to be careful with some of these things and get out of the ideology of I don't like renewables and it's IEA net zero is dumb, which I do think it's dumb. Right. But there's a motivation for China, again, to have coal-fired EVs over OPEC-fired ICE vehicles if it is balance of crude demand and imports that they care about, which I think they do. And to me, that's the motivation for their EV policy. I do not perceive it to be a climate policy. I perceive it to be a limit oil demand imports policy.
Yeah, that makes absolute sense. All right, moving back to Eric. Eric, your next two questions come from Twitter. We have your first question comes from Elini. Given refining spreads and the slack in the oil market seems to be coming from production, and Canadian production has increased over the past year, do you see further increases coming from Alberta? And do you see Canadian producers leveling off or cutting at current prices?
Well, so there's no cutting of production related to the price right now. And so everything I'm about to say is kind of adjusted for the forest fires. I think we were looking for fairly modest growth, not just this year, but going forward, largely due to capital constraints, the focus on deleveraging. We've got most of the big guys hitting their leverage targets by the end of this year. If we're directionally accurate on the oil price at strip, it'd be like early next year. The necessity to further increase dividends, most again have committed to 100% of free cash flow, inflection going to buybacks. We have that again by the end of this year. So I don't see a huge decrease in activity nor a big ramp. It's kind of steady state. CapEx budgets have been set. They were fairly bulletproof, and companies are just going to continue to execute. A lot of it is going to be there will never be, I think at this point, another greenfield project in the oil sands, at least for the foreseeable future, like the next 10 years, certainly under the current government and existing legislation, which makes them very, very cost prohibitive. So I would think of Canada just kind of like slow, steady state, 100,000-ish, give or take per year, depending on project timing.
And then your next question comes from Man United Forever. Question for Eric. Does Eric think Biden administration will further release oil from the SPR after his mandated release of the 26 million finish? There's about 4.6 million left. So I guess the question really is, do you think the Biden administration will further release oil?
Yeah. So I have no special insight on that, but I think you've got to reflect on why did they do the initial release. And you could say, okay, well, it was under the false guise of the IEA saying that Russian production is going to fall by 3 million barrels per day. It's my own personal belief that the IEA's become such a massively political institution. Their unexpressed wish is to be as bearish as possible on traditional hydrocarbons and talk prices down for the benefit of consumers in the short term, anyways. So it was that false guise that allowed the Biden administration to go ahead with the release, with the intent of pummeling the gasoline price heading into the midterms. So you don't necessarily have that dynamic in this next go around. I got to attend a luncheon where Amos Hochstein was presenting, so it was all public commentary. Nothing like massively revolutionary, but he did say at least. So you've got to look at actions and then words, but the words do line up that their intent is to somewhat replenish what was released, approximately 40 to 70 million barrels when you account for the years of canceled sales. I think 25 through 27 or 24 through 27. So no, I don't think there's the political alignment now as there was when, oh my God, we're going to spike to $300 oil because we're going to lose 3 million barrels per day, et cetera. It's different today than it was a year ago.
Yeah, and I would argue, even though they are trying to, replenish, if you want to call that, with their 6 million barrel token SPR buy, that, I really don't see them actually buying a lot, not in front of an election.
I 100% agree. I think we should just ban from our minds that they're going to actually buy back, and I don't think they're going to sell again. So it's either a bullish nor a bearish catalyst.
Absolutely great. And then my next question. So we've seen a lot of rather big M&A deals over the last 2 years, particularly this year where there's been less deals, but much larger amounts of money. So do you see further consolidation in this industry, either in the US or in Canada?
Yeah, so it's a question that's becoming more and more popular to ask. I always think M&A, it's what problem are you trying to solve? Because right now, like the spread between small, mid caps and large caps, I don't think is wide enough to justify that. And M&A often makes sense on a spreadsheet. And in practical matters, when you're dealing with people and different cultures and whatnot, it's a lot harder to properly execute on. So I always think of, okay, M&A is meant to do two things. One is to heal a broken balance sheet, or your inventory depth isn't adequate and you have to replenish or you need to increase. So we've seen a couple acquisitions, at least north of the border, where it was inventory driven by mid caps. When we look at the health of the balance sheets, if we have this sector debt free, should they so choose by Q2 of next year, that's at 80, admittedly, so push it by a quarter, so at strip. So balance sheets unquestionably are incredibly strong. And I don't think people appreciate that. As an investor, you should always think about risk. And yeah, we take on commodity risk, obviously, but from a balance sheet perspective, balance sheets are just so incredibly strong. So then I look at inventory depth. We've kind of beaten this horse to death, but inventory depth here is incredible. Like I have 13 holdings in my main fund, and on average, they'd have about 17 years of stay flat inventory. So that's more than adequate as well. So the only two areas I see M&A largely, one is going to be privates to publics. You've got end of life fund issues with PE guys. Inflows to outflows, I think, is still like a 7-to-1 ratio. So every dollar out, you've only got 10 to 15 cents coming in. So the liquidity window is really going to be privates to publics. I think you saw that in the Permian last night or the day prior. In Canada, I think that's likely as well. Secondly, given the cash taxability now of the sector, which is a great indicator of profitability, there are some companies that have massive tax losses that suddenly are becoming quite valuable. And so we've got a couple holdings which we think that there's strategic value there that isn't being recognized by the market. So those are the two primary areas. I think, generally speaking, inventory depth is more than adequate. We've got some companies, they'll say they've 50 years in the Montney. Well, tacking onto that, unless it's you're competing with existing, drill ready inventory is dumb. So balance sheet strengths are strong enough, inventory depth strong enough. So it's just going to be privates to publics and potentially tax losses.
Excellent, thank you. And then moving back to Arjun, you highlighted some questions at the beginning of 2023. One was underlying trends on return on capital employed. So what if oil prices and return on capital employed fall in 2023, does it mean that this upcycle is over? And then in a world that favors ROCE and dividends, is a diversified E&P business model preferable to being a pure play?
Yeah, those are both great follow-ups, Tracy. Thank you. I think first on the returns on capital, like I think there's actually nothing I could be more excited about that I've seen over the last 4 quarters is that we've had down oil prices for 4 straight quarters, including the first quarter of 2023. And you've seen return on capital remain above the regression line to the point where when you look at a sector, the question to me is always, what is your trough? What is your peak? What is your normalized? The trough return on capital was a massively negative number at the depths of COVID. And for many companies, it was a pretty abysmal average number for the past decade. If oil were to actually average $60 a barrel, the sector is probably still doing a double-digit return on capital. Maybe not every last company anymore, but that is actually pretty exciting to see that your trough return on capital, at least at this moment of where we are in the structural return on capital cycle, is going to result in who says 60 is the trough? Maybe it can be a lower number, but the idea that you can earn at least a cost of capital and maybe better than that at a trough, and in a deep trough, maybe we're break even if something terrible happens over the next year. All of that to me speaks to the underlying health of this sector. And again, I know people very much have trading mindsets, and then probably that's especially true on a Twitter space type call where people clearly want to know is tomorrow's inventory is going to be bullish, and if it's bullish, the contango increases and the spot pricing. Like none of that is what interests me personally or my focus area. It is what is going to create a great company or great sector. And usually it's the company because you can't count on a commodity sector to stay great. So it's going to be the company. What allows you to do what Exxon and Shell did from 1910 to 2010, where they were the largest, most dominant companies 120 years ago, and they remained that 10 years ago. They've fallen back a little bit. Hopefully they're going to get back up off their feet. That's what we're after. And when I look at how returns on capital have progressed for the sector, it keeps me very, very excited. So I understand it from a trading standpoint. If sequentially you're down, that's a headwind for sure. And if we do rally in the second half, as some people are articulating, great. The most important thing for this sector to be re-rated is to maintain double-digit mid-teens returns on capital. Again, maybe not every company, but certainly our best-in-class companies, and to pay out the excess cash and dividends. I think the point on being diversified a little bit gets into the role of M&A and the role of CapEx. So to be returns focused, to pay out a disproportionate amount of dividends and stock buybacks, that does not mean you spend nothing on your core business. In fact, you'll never sustain returns on capital. You'll never sustain dividends or stock buyback by spending nothing. So it is about spending wisely, and that's a big qualifier after a really bad decade. I get why investors are very skeptical of the management teams. But let's just say we are in a point where the non-OPEC curve is starting to mature, where it's starting to steepen. And let's say, while I won't say that we're currently in a super cycle, that inevitably you're going to need greenfield expansion in a world where oil demand is growing at least around 750 to 1 million barrels a day. In that kind of world, you will need greenfield expansion to come back. And we are far from that. We're far from exploration come back. We're far from new oil sands projects. Forget about debottlenecking, new oil sands projects coming back. And I think we're going to need those as well. So that day will come. It just may not be the second half of 2023 or even 2024. Right? That day is going to come. It's better to add those resources. It's better to add those projects. It's better to do M&A now at a time of skepticism, at a time when you're still closer to the trough of the CapEx cycle. And so it doesn't mean every deal that was done in the last 6 months was a good one. Some probably weren't, and maybe a few were. I think it's easier to see the ones in 2020 or 2021 as sort of being generally kind of well-timed, if you will. But from an aggregate standpoint, you would rather spend when you're not in a super cycle, when there isn't massive CapEx and cost inflation. You still have to make good decisions. If you buy the wrong asset that's the wrong end of the cost curve or is about to mature, or they already drilled up all the good wells because it was a private equity company, like those kind of situations, you can do a bad deal at any point in the cycle. But the sort of critique of some companies that all spending is bad, like that's not accurate. To be Exxon and Shell from 1910 to 2010, it wasn't from harvesting their 1910 oil fields, obviously. It's about ongoing investment and what is going to be the low end of the future cost curve. That is the judgment. And that is what we trust managements to do. Who is going to invest properly and, with some insight about what is going to be the future low end of the cost curve. And I think there's a huge role for Canada to play in this. I think we will see exploration come back. We're far from that today. We're probably going to have to get people to unretire to explore. I unretired to join Veriton as a partner, and we're going to need some exploration people to unretire to start finding oil and gas, since I think oil and gas demand will grow going forward. So that's just a huge part of what I think will need to happen. So, and again, I've made another huge speech, so I probably forgot one of the questions, but thank you.
That was perfect. I think the last one is a diversified E&P model.
Yeah, diversified, yeah. I mean, so like, there's no history. Well, I shouldn't say there's no history. What are the basins? I'll ask everyone. What are the basins where you do not have to be diversified? So one of the answers, I'm going to make it rhetorical, so I'll answer myself. Like if you're Saudi Aramco and you have exposure to Saudi Arabia, yeah, I think maybe Saudi Aramco does not need to diversify. Like I think I'd be pretty good if I was doing E&P in Saudi Arabia. Great country to do E&P. I think another example of that is actually Canada's oil sands. If I have good exposure to Canada's oil sands, I don't think I have to diversify. Now, you may want to try and keep the Canadian government honest. I will say in the U.S., if you are a leading player in the Fayetteville Shale, and then you got your knees knocked out from you because the Barnett Shale came around, and you're a Barnett Shale player, and then you got cut off by the Marcellus Shale, like there is a history of you can't stay in one basin, and you do have to move around. Now, is the Permian an exception to that? Is the Permian like Saudi, and Canada's oil sands? Maybe. I think that's, we might wonder about that. But I think there's and part of it, though, is Canada's concentrated. Saudi is highly concentrated. It's one company. The Permian is anything but consolidated. So your ability to sustain as a dominant portion of, say, the S&P 500, which has to be the objective. You're trying to beat the S&P and be a dominant part of it. Again, measured over decadal type timeframes. That's the objective. I don't think there's any chance you're going to really do that, being sort of singular basin focus. So then the question is, how and where do you diversify? How do you do it where it's not diversification? Again, I totally get all the pushbacks investors understandably have about companies that have diversified. And I think there's no answer for this Twitter Spaces to that, other than there's not a history of staying single base. There's only a few exceptions, I should say, being single basin focused and being able to perpetuate yourself measured in decadal type timeframes. And I think every company needs to figure out what is their diversification strategy. I think there are lessons to learn from private equity where you don't try and do it yourself. You partner with best-in-class management teams who are experts in that area, rather than thinking the executive leadership team of your given oil company knows everything about every basin in the world. So there are many different ways to execute how you think about growing your opportunity set. But I think for companies that want to be S&P outperformers, that are large cap companies that are going to want to dominate, but even the small caps, if you're a single basin company, by definition, you probably have more limited inventory. Then the question is, when are you going to sell to somebody else? Or liquidate. That's the other thing I throw out there. Maybe liquidation in this net zero-ish kind of world is a viable strategy. And I'd like to see at least some companies do that, where they just say, we're giving you back all the cash. So I guess you don't have to diversify. But if you're smaller, then you're thinking liquidation, or you're thinking I'm selling myself. And they don't all think that, right? There is the history of, I'm a management team, I want to be bigger. I get the investor concerns about that.
Well, being that you said, right, any thoughts on Shell's kind of turnaround here, where their turnaround on their stance on oil, saying, they're kind of getting away from diversification, going back to oil?
I personally love seeing that, because it's an admission of the just horrendous returns in many of the alternative realms. Wind, solar, it's just they're dismal. So I've threatened any of my companies, and no one's even contemplated it, but if you dare take $1 out of high margin and invest in low margin, like we'll immediately liquidate. So that was gratifying to see, and I think it speaks to the realism that demand for oil will last longer and stronger than the eco woke narrative of the day.
And I might phrase this slightly differently, but I think I come to the same conclusion, which is oil and gas companies should first and foremost be great oil and gas companies. And when profitability was poor last decade, first show that you know what you're doing in your base business, which they're starting to do. This is going to be year 2.5 of much better profitability than we've seen historically. And I do think because the world is going to need oil and gas for a long time to come in most likely growing quantities, we should want our US, Canadian, and European oil companies to be great oil and gas companies. And the idea that when I talk about diversification, I'm talking about basin diversification for large companies. I'm not talking about going into businesses that they presumably know very little about. Now, if you have a venture capital portfolio, if you're Valero or some of these companies that are doing renewables, fuels, like there are some logical adjacencies that I understand. And I think you deal with your scope one, you deal with near zero methane. Those are clearly responsibilities of this sector. But the idea that they're going to be experts in EV or power generation or any number of other things, I think I share Eric's extreme skepticism that is going to work out for these guys.
And then before we wrap this up, we have just another couple of questions from Twitter, and these are open to whichever one of you would like to answer. One from Forset. What are your thoughts on crack spreads and refining for the next 12 months?
Arjun, that's over to you. That's out of my expertise.
I'm not a huge short-term crack spreader anymore. I will give the refining sector credit, just to stick to my themes, as having excellent profitability last decade. I think the questions one would ask is, in a lackluster U.S. demand environment, if the day comes when shale does mature, does that somehow change that trajectory for the U.S. refiners? Maybe. On the other hand, you continue to see OECD capacity closures. We still have generally low-cost refiners. Historically, they've been able to run heavier crudes if that's something that comes back. So I don't have some strong 12-month crack spread view. I suspect it'll be part and parcel with, does the demand outlook improve? I'll give the refiners credit for generally being sort of committed to this sort of, let's focus on profitability, let's give most of the cash back to shareholders. And, in that sense, I think they still got a fighting chance to be relevant. So.
And then the next question was, despite compelling metrics and market dynamics for the industry going forward, how does it work if Canadian and U.S. governments continue to attack the industry with all the tools at their disposal?
So as a Canadian, I'm going to be biased here, but I think that you've got to recognize, and I think our federal government, you're seeing it from the language, there is a pivot, which is extremely gratifying, but it's 15% direct and indirect of the Canadian economy. It's very, very high paying or good paying jobs. And it's a lot of royalties and taxes that are spread to voter rich areas such as Quebec and Ontario, whether those people, and I live in Ontario, whether they recognize that or not. So it's not like a jurisdiction where, it's a small part of your economy, it's a small percentage of your stock market, and you can alienate them and it doesn't really cost you anything. Canada is not that. So I'm not overly concerned. I think we've reached peak. The polite term I use is energy ignorance on the part of Canadian policymakers. I think we're past that. And
I just call it insanity. What?
Yeah, I have to be more polite. But there was some craziness. There was some craziness being talked about and thrown around. But I think our government recognizes the importance of the sector, and that comes from fairly well positioned people who share that view. So I think the perceived political risk is not as valid as some people may think.
I would concur with a lot of what Eric just said. Obviously, he's much more of an expert on Canada specifically, but I think a lot of those sentiments hold to the U.S. where, at least right now, we're past peak insanity. But of course, we have had a pullback from 120 to 70. So if we somehow did go back to 120, which is entirely possible at some point here, you should fully expect that insanity to return. I will say there is a misperception that political party is necessarily relevant to how the equities do. So you can go back in time and look at Republicans or Democrats in the US, and I'd be hard pressed for anyone to show that Republicans are, quote, good and Democrats are, quote, bad for how the sector actually performs or their profitability. Biden period's actually been good, the best profitability period this sector's had in a long time. The previous administration of Trump years were some of the worst years of profitability, but you can yin and yang both ways on that if you keep going back in time. So I do think sometimes too much focus is put on this. Unfortunately, in the U.S., we do still have states' rights. And since most of the shale is in Texas or North Dakota, that is generally helpful as well.
Excellent. Well, we're coming up on the hour. I want to thank you both for your time. It's time for the final round. The final round, the last question. So Eric, tell us something, either you want to talk about that we didn't have a chance to talk about, or, as investors, really, what should we be keeping our eye on for, the next, 12 to 36 months?
So we remain bullish on the second half. I cannot recall, I've only been around 20 years. I think Arjun's 30-ish. I can't recall a time when there's such a stark contrast, I think this year between the first half and the second half. It feels like we should be weeks away from an inflection in sentiment. I think tomorrow might help on that. And so when you look at this bearish narrative that we've been battling, at least there's a short-term curative, I think, coming. And so when I think about a sector that has experienced such massive outflows, certainly relative to tech for the better part of a year now, when I look at companies trading at low teen free cash flow yields at the current price, where I think my average holding is discounting an oil price of about 55, the risk versus reward, I think, for people is still incredibly compelling. So it's been a grind. Like this year's been a real test of one's convictions, but I remain very, very optimistic about what the next several months and quarters and years have in store for energy investors.
And then Arjun, same question. If you want to talk about something we didn't get a chance to touch on that you think is important, or really what should we be, on the lookout as investors in this sector?
I mean, I'll try and be more brief and not repeat everything that we just said, other than I certainly share the constructive view over the long run. I think a 4% S&P weight is not where this sector will end up. My personal number is we will be back to a 10% S&P weight. I think whether the turn is as imminent, I'm probably less certain about that. That's the part that I am less sure about. On the other hand, the idea that if I'm sitting in, down the road several years, while I'd be happy to have generally owned the sector in and around current levels, I mean, I think I will look back and say, hey, if I bought the sector and it's around a 4% S&P weight, I'll be very happy. What I would encourage people to do is look at Canada. I think Canada is really one of the most interesting areas, that long life production. There's some really well-run companies there. And I will have a shout out to Eric on this regards, whether it's him or anyone else. Get to know Canada. I just view it as one of these linchpins to having a healthier energy evolution. The fact that they're going to have a pipeline going west is a great thing for Canada. I hope we'll get Canadian LNG down the road. The rest of the world could use that as well. And it's generally an area where the Permian is still an area where all the deal activity goes. So it may not be as hot as it once was, but it's also not super cold. Canada may not be cold like it was 2 or 3 years ago, but it is an area that I continue to try and do a lot of work on personally and remain very excited about.
Excellent. Well, thank you both, gentlemen. I think today gave us a lot of great insights. I'm sure everybody is very thankful to have you. Please follow these gentlemen on Twitter. They have fantastic insights. Arjun has a Substack. Follow Place Your Trades to find out what other events that we have coming up. And again, thank you. Thank you to the listeners. And we'll see you next Wednesday.